Hey, hello. Happy Saturday, everybody. Happy webinar day. I hope everybody's doing good today. Hope everybody's having a good weekend so far. I'm excited for this one is on risk to reward. It's just another key component to trading that, guys, I go through these webinars every week. And honestly, each thing we go through is just a piece of the puzzle. And once we start adding them together is when things really start improving for us. So I'm happy to have all of you here. Let's get started. I'm going to give it just another minute or so just to let people join in. Hello, Cliff. Hey, Victoria. What's going on, guys? Always good to have you guys in here. Again, this one's going to be on risk management, risk to reward ratio, how we could implement it, and so on. And, I got a really cool, thumbnail on this one today, courtesy of one of our new members of Bullishbrs. So happy to have him. What's going on, Cliff? Hello. All right, we got some more people joining in. Hello, everybody, and welcome to this week's webinar. I'm just going to go over one more time. It is going to be on risk management, risk to reward ratio, how we could use that in our intraday trading, even our swing trading, and how we could have a good, solid risk to reward ratio help keep us profitable longer, even if we take more losses than we take at winners. All right, so let's get into it. So risk to reward ratio. So what is risk to reward ratio? Risk to reward ratio measures the potential reward gained from a trade in relation to the amount of risk taken. It compares the distance between the entry point and stop loss, which would be the risk, right? Our stop loss goes where we're okay with losing X amount, and if we're wrong on the trade, that's what the stop loss is for. To the distance between the entry point and take profit. That would be our reward. When we hit our take profit, that means we reached our reward on that trade. A favorable risk to reward ratio ensures that potential gains outweigh potential losses, contributing to long-term profitability. Again, guys, this is huge because you could have a 3-to-1, a 4-to-1 risk to reward, and when your trades maybe 30-40% of the time, but still be profitable and still be a profitable trader. And that's what risk to reward does for us. It unlocks an enormous amount of gains, guys. It's really great. It's an essential concept in risk management and trade evaluation. So how do we calculate risk to reward? To calculate risk to reward ratio, we divide the distance between the entry and stop loss by the distance between the entry and take profit. For example, if the stop loss is 10 points away and the take profit is 20 points away, the risk to reward ratio on that would be a 2-to-1. You're risking 1 to make 2. So evaluating risk to reward ratio in terms of pips, points, or percentages helps determine that ratio. So we could go however, we could measure it however we want, but we usually do by points. If we're trading something by futures, or if you're trading stock, you could go by dollar and ticks, or ticks would be the penny moves. So different risk to reward ratios can be utilized based on trading strategies and market conditions. So that again wraps up to our previous webinars, right, where we go over chart patterns and we go over different types of ranges and pivot trading. Risk to reward could be thrown into all of these other tools I've given you, and then you could really see where the good entries are with a good stop loss, where your good take profits could be as well, and you could really sort of dumb out the bad trades that you shouldn't be taking. A 1-to-1 is not the best unless we're scalping, right? So there's always different reasons or different conditions in the market or different trading strategies that we have to be aware of when we implement risk to reward, but we do have to know that all in all, a higher risk to reward ratio, a 2-to-1, a 3-to-1, comes with a lot more gains and a lot more sort of more stress-free, because our winners are really taking over our losers, whereas we could go on, if we have a 3-to-1 and we win 3 in a row, we're at $900, say if one is 100, and now we lose 4 in a row. Well, now we're still up $500, but we just lost 4 trades after only winning 3, but we're still green in the money. So that's a really, really great help. Especially, if we feel like we're getting into trades too soon or too late, or we feel we're chasing, it keeps us in check to watch for a good risk to reward and it sort of lets us take an extra loss or two as long as we're implementing a consistent risk to reward across all of our trades. Hey, what's going on, Anthony? Welcome. Appreciate you hopping in, man. Alright, so let's see. I just want to show you the example on this one. This was actually a trade that we had set up in our live stream on Friday, right? So this was a liquidity grab, which means we broke the highs on this wick, but we failed to hold above the highs, and what we did was we had a fast rejection lower. This risk to reward is a 4.69, so almost a 5-to-1 risk to reward. That's a fantastic trade. You could win 2 of these and then lose 5 or 6 of them and still be profitable. You could lose 8 of them, still be profitable. And that's what's so great, guys. You could take loss after loss, but your winners are so great. Now imagine you're not taking any losses and you're keeping a strong risk to reward and you're making 5-to-1 on every other trade. Your account's going to be phenomenal. Your trades are going to feel great and your reward is going to be healthy. So again, different risk to reward ratios can be utilized based on trading strategies and market conditions. Sometimes on ES, as an example, we might have a 20-point range, so it would be understandable to sort of shoot for 10-15 points. Whereas if we're in a smaller range, it would be unreasonable to want that much going for us. So we might want to take a 5-point or a 2-point or even scalp a couple points, right? So let's hit the next slide. And why is risk to reward ratio important? So risk to reward ratio ensures that potential losses are limited and potential profits are maximized. Again, guys, there it is. We want to stop our losses. We want to cut our losses short and let our winners win, right? That's what the stock market's all about. It helps maintain consistency and discipline. So if we're aware of where our risk to reward is on a trade, it might help us stay out of, say, chasing a trade or chasing a trend. If we have no proper stop loss in that trade and we're trending, we might have to sit this one out or wait for some sort of pullback or lower high or higher low, depending on the trend, to take so that we could place our stop at the previous swing low or previous swing high, depending again on the direction of the trade. Positive risk to reward ratio provides a buffer against losses, allowing traders to withstand losing trades and recover more easily. Again, guys, there it is. It's to be able to win 2 or 3 and then to, by any chance, take 4 or 5 losses and still be profitable. It's so you're not fighting against the market all the time. You're going with the higher probability trades with some higher probability risk to reward ratios, and that's what we want to do. We want those higher odds in our favor when we trade in an unpredictable market. So it plays a vital role in overall risk management and trade selection, right? So there it is again. So this is the same move as this move right here, but the chart is zoomed out. So if we enter this trade, right, this is another liquidity grab situation where we wicked this high, we wicked above it and failed to trap people in the wrong side of the market, and then we pushed lower. So our entry would be on this candle once this candle breaks below this candle's open. But if you put your stop loss at the previous swing high, this is a 1.3-to-1 risk reward. That's not a favorable risk reward. That's not good. We don't want to be doing that. But if we understood the candlestick structure and we were able to put our stop loss at the 4-to-1, right, and be able to see this is our gain and this is our risk, this is a bigger gain than it is our risk, and we never even came back in the red on this trade. Would have been a great trade setup, a great risk on it, and a really great reward on that. And this would be a trade that you could implement, execute, and lose more often than you win, but because it's 4-to-1, you could still stay profitable. And I have a chart coming up soon, guys, going over exactly what win percentage you need in order to have a good 4-to-1, 5-to-1, 2-to-1, 3-to-1, and all of that. Alright, so how to find favorable risk to reward opportunities. So this comes back to the chart patterns, understanding how to read charts, understanding how to read candlesticks, price action, volume, whatever you use to understand and to read charts is how we implement risk to reward as well. So we analyze trade setups based on risk to reward ratios to assess the potential for profitability. We look for setups where potential rewards outweigh potential risks by a significant margin. Again, guys, risk to reward is all about having a heavier reward versus a weak risk. Because if we could lose little bit on the risks, but when we win, they're big winners, it's really going to make trading less stressful. Not going to say it's going to be easier, but it will feel less stressful because when you hit those winners, it will take care of your losses. So aiming for a higher risk to reward ratio minimizes the impact of losing trades and maximizes the potential gains, leading to long-term profitability. I'll say that one more time, guys. Aiming for a higher risk to reward ratio minimizes the impact of losing trades and maximizes the potential gains, leading to long-term profitability. That's what we want, is long-term and consistency. That's right, Victoria. Gains. We want good gains and weak losses. We cut our losses short. We let our winners win, right? So when we're in a trade, as this is an example, but let's say we had a pullback here, right, on this wick. If we had our entry up here and our stop loss here, we're respecting this. So when the candlestick decides to pump all the way back up here, we're not going to be affected. We have our stop already. We have our target. We're waiting for that to hit. And how I found this trade, and again, this was one that you could go back to Friday, and we sort of saw this one play out. The target was this key level, and there was a 15-minute demand zone right under it. So again, this was a 4-to-1, almost a 5-to-1 risk reward. It was, again, from the previous screenshot. And it's just super helpful, you know? You got to combine technical and fundamental analysis to identify setups that align with favorable risk to reward. So again, if you trade something like a moving average, as long as you're able to say, okay, well, when it comes off the moving average, I see where my stop loss is. My stop loss will be a pivot low or a pivot high. And my target will be the next swing high or a previous day high or something like that. So again, guys, risk to reward isn't going to give you where your target is and where your stop is, but what it is going to tell you is it's going to measure where your target is and where your stop is. And by measuring those things, we could put together if this is going to be a trade that's more favorable or if this is something that we should probably stay out of. So again, 1-to-1 risk rewards, even a 2-to-1. 2-to-1 is okay, right? Because you could win, believe it's about 40%. Again, I have a graph coming up in a few slides that goes over exactly what percentage you need. And it's very helpful, guys, again, to be able to be a profitable trader, but potentially take more losses than you have gains. That's what will help us stay profitable. Not forever, but longer, consistently. Consistency is key. So if we consistently stay with the 3-to-1 risk to reward, golden. Consistently 2-to-1, consistently 4-to-1, anything 2-to-1 and higher. I'm not a big fan of 1-to-1s, guys. You need to win 60%, right? So, okay, 60% is not the highest win rate, but you're going to be barely profitable, right? So there's commissions, there's all these other aspects that will burden our trades, and having a 1-to-1 is it's difficult, right? So we want something higher, a 4-to-1, so when we win that one trade, that 4-to-1 could cover 3 losses. So one winner covers 3 losses, and you're still profitable. So what risk management strategies can be utilized? So implement effective risk management techniques such as setting stop loss orders or position sizing, right? So sometimes we might feel the need to go extra heavy on, say, ES or NQ, and what happens is once we're in an order, once we're in a trade, say we enter right here, hypothetically, if I enter and go heavier and enter another contract here, what that does is it brings my average down. So it brings my entry price average down. So yes, it will still do better once stock continues in my direction, but now my risk to reward is swayed on that. So we would have wanted to be in our position in the box right over here so we could know where our risk to reward is. So adjust position sizes based on risk to reward ratios to ensure consistency and adherence to risk limits, right? So utilize trailing stops as well. Trailing stops are a huge help. So let's say we are in a trend and you don't want to cut off your winners, but you also don't want to, risk everything. You could throw a 5 point, a 7 point. It all depends on the trade strategy, the trade setup, and the range we're in. But a trail stop, what that will do is for every point we go higher, the trail stop will follow. So if you have a 5 point trail stop, what'll happen is, let's say it goes up 5 points and then it comes down 3 points, your stop loss is now 2 points away. But if it goes back up and continues to now 10 points, now your stop loss has risen and come up as well to 5 points. So if it comes back down, you're stopped out and still profitable. So a trail stop is good, but a lot of times the market likes to stop us out before continuing trend. So I would be careful with trail stops. A lot of times what I like to tell our members is when we enter a trade, if it's a solid trade, we have a good exit point, we have a good target, a good stop loss, we want to set and forget. We set the trade, whether we're short on ES or long on NQ, and we set our stop, we set our take profit, and we set and forget. We could walk away, we could go take care of something, we could go make a phone call, go watch a show, set some alerts, and we could set and forget that trade as long as it's a high probability trade, meets our standards, we did some type of technical or fundamental analysis on it, and the risk to reward is in our favor, then we're able to set and forget and have some stress-free trades. And even if it goes against you, because we have a high risk to reward, it's okay if it goes against you, get a notification saying stop filled, because we know the next trade, we again will be taking a 4-to-1, a 3-to-1, and when we start hitting those are going to take over our losses very easily. So regularly review and adjust risk management strategies to align with changing market conditions, right? So right over here, I wrote how 10-point move on one ES contract is $500 because it's $50 a point, but a 5-point move with ES with 2 contracts is the same thing. So again, it's all about position sizing. If we're in a weaker ranging market, you might want to add more contracts so that, let's say we have a 5-point stop or we have a 10-point stop usually, but the range is a lot smaller. So we might want to add 2 contracts to that. So why is consistency in risk to reward ratio important? Consistent risk to reward ratios contribute to overall trading consistency and discipline. It helps to eliminate emotional decision making by following predefined risk management rules. Consistency in risk to reward ratios ensures a balanced approach to trading, minimizing the impact of individual trades on overall portfolio performances. So here's that chart that I was telling you guys about. So if you have a 3-to-1 risk to reward on all your trades, you're consistently doing a 3-to-1 or higher, you could win 30% of your trades and still stay profitable because the break even is about 26%. But 30% win rate and still profitable, that's amazing, right? So imagine, you get deeper in the money, 50%, you're doing well. Now let's look 4-to-1, 5-to-1, 20%, again 30%. These are some great things and great concepts that will help us really capitalize on our gains and minimize our losses. Whereas if we go to the 1-to-1 risk to reward, we need 60%. We got to win 60% of our trades. Whereas 3-to-1, we could only win 30% and still be profitable. So you see the difference it makes? Imagine only having to win 3 out of 10 trades and you're still a profitable trader, whereas somebody who has a consistent 1-to-1, they might have to win 60% or more, and sure, they might, right? It all depends on trading style. There's some styles and strategies that are consistently a 60, 70, 80% win rate, but the risk to reward is 1-to-1. So with those, they're very close, they're very careful, and they're scalping. They know what size to trade. And again, guys, it's all about consistency. It's all about a bit of trial error. That's why paper trading is always good too if you're practicing something. These Apex, these funded trader accounts are also a great thing too. You pay for the evaluation account. They give you an account, they give you your trail stop, they give you a target, and you're trading with their money, which is still paper money, but you're given the opportunity to then trade futures, you're given the opportunity to work on a good risk to reward ratio, and you're given the opportunity to work with real money again, but it's not real money, you're just putting down however much it is for that account. So let's see. So again, guys, I'm going to give you one more second to look at this table real quick. Again, guys, I mean a 5-to-1 risk to reward. If you're winning 20% of your trades, that's 2 out of 10, guys. 1 out of 5 trades, and you're still profitable. That's an amazing risk to reward. That's something to be proud of right there. But again, 5-to-1, those might not always happen, right? So if we could keep it between 3-to-1 and 5-to-1, huge. Again, even 2-to-1, 40% win rate, that's still less than half. That's huge. If we could keep a high risk reward so we could have a great win rate chance, right? So we could potentially lose more than we win, that is key. So over time, maintaining a consistent risk to reward ratio enhances the trader's edge and the potential for long-term profitability. I know that probably sounds like a broken record by now in this slideshow, but that's what this is all about, guys. Risk to reward is all about giving us an edge and having us have that potential for long-term profitability because we're sticking to some rules. We're sticking to, let's say I have a rule where I let candles close, I only trade off the 15, and now I have a new rule where I only take 3-to-1 risk to reward. Well, now I'm eliminating the fact that I have to be profitable more likely than not, because now I only need a 30% win rate to be profitable. And again, guys, that's huge. So a lot of people feel the need to always be in a trade. They feel the need like the market's open, I have to take a trade. That's not the case. We want to find high probability trades with high profitability, right? High probability and high profitability. That's what we want. We want great rewards, little risks. We want high probability because of supply, demand, key levels, support, resistance, swing highs, pivot highs, ranges, any of it, guys. We use those on top of our candlestick patterns and what kind of chart patterns we look for, and then we calculate it with risk to reward to find our entries and exits, and that's how we could build consistent trading plans and consistent trading strategies that will help us improve and really do well over time. Applying risk to reward in supply and demand trading. So obviously, guys, I'm a big supply and demand trader. If you guys have seen the lives, I'm always trading supply and demand. I'm always teaching supply and demand. It's a big thing in our community, and a lot of members do enjoy it too. Love it. It's great stuff. Supply demand, key levels. I call key levels. That's just support and resistance. So I do like throwing these types of slides in there to just keep up with speed on my personal trading strategy along with whatever we're teaching, right? So last time it was pivots, this time supply and demand. So supply and demand trading focuses on identifying areas where imbalances occur between buying and selling pressure. When analyzing supply and demand zones, traders can evaluate the potential risks or reward ratios in their trades. So let's say this was the demand zone, and this is a previous swing low. You see, guys, just like the pivot webinar, this was a lower high, a higher low, a higher low, and then we created another higher low. And let's say we have our entry at demand and our stop loss at the previous swing low. So that's the previous higher low. And we had our take profit all the way up here at the next key level. This was a 2-to-1 risk to reward, so it wasn't 3-to-1, but again, guys, if we could keep it 2-to-1 and higher, that's definitely in our favor. So in supply zones where sellers outnumber buyers, traders can seek trades with favorable risk to reward ratios by selling at higher prices near resistant levels. In demand zones where buyers outnumber sellers, traders can identify potential long trades with favorable risk to reward ratios by buying at lower or near support levels. And we could use previous we can use previous pivots along with supply and demand to implement proper stops as well. Again, guys, it's exactly what I did here. And even with supply and demand, guys, if you wanted to just enter right at demand or enter right at supply, as long as the zone's small enough and your take profit's far enough, you could put your stop at the bottom of your zone and the target at the next key level or the next zone. I personally wouldn't recommend it. I would probably wait to see the price action and let the chart formation happen and then enter the trade. And again, maybe put your stop off of a previous low in demand or a previous high in supply. But that's just me. And again, guys, trading is all about experience, working on it, computer time, being in front, watching the charts move, watching price action, and understanding how price moves with volume. So account size and risk management. So account size plays a crucial role in determining risk management strategies and position sizing. Smaller account sizes may require more conservative risk management approaches to protect capital, right? So traders with larger accounts have more flexibility to allocate risk and potentially take on higher risk to reward opportunities. So, somebody with a higher account, somebody who has more capital, they might be able to take more one-to-ones as long as they know what they're risking. Whereas somebody with a smaller account, your best bet is to take only those 3-to-1s, 4-to-1s, because if you do lose on those, you have more chances. If you're taking a lot of 1-to-1s, it's going to be eating away at your account, and your winners will not help at all. That's why we want to be a higher risk to reward ratio, again, especially on the smaller accounts. So adapting risk management based on account size ensures a balance between capital preservation and maximizing profit potential. When trading, we should try to risk no more than 2% of our account. Now, that's something that's said amongst a lot of traders, professional, experienced. A lot of them know it's about the 2% rule, right? We try to only risk 2% of our account on trades. So for a $10,000 account, risk amount is 2%, so that would be 200. A $25K account, 2%, we're looking at 500. A $50K account, we're looking at 1,000. And a $100,000 account, we're looking at about 2,000. And how you find the percentage of whatever your account size is, let's say you have a $4,000 account, $16,000 account, you're going to multiply your account size times 0.02, and that's going to give you your total of what your risk should be. So risk reward and different trading strategies. Risk to reward ratio is an essential consideration in various trading strategies, such as trend following, range trading, and breakout trading. Trend following strategies often aim for higher risk to reward ratios, allowing traders to run with the trend and potentially capture larger profits. So again, guys, if we're in a small range of ES and it's in a 5 to 10 point range, we shouldn't be expecting a 20-point move. We should be trying to scalp 3 to 5, maybe 7 points, again, depending on the range. If we're buying low and selling high, we are scalping in a range. But if we're trend trading, we're able to implement a trail stop, and we're able to really try to capture and hug the price action with the trail stop so we could capitalize on the bigger move. So range trading strategies may focus on smaller risk to reward ratios. Again, guys, if we're in a smaller range, we do have to have a bit of a wider risk to reward because it's very range bound and it's more unpredictable than when we're trend trading. So range trading strategies may focus on smaller risk to reward ratios, taking advantage of shorter price movements within the range. Again, guys, shorter price movements is key right now with ranges, right? So we have short price movement, so we might only trade a 5-minute candle, maybe 2. Whereas again, if we're trend trading, we might even be on the 30-minute or hourly candle and be trading and trend trading on that, so we could really capitalize on a big move. And if you guys weren't here for the pivots and the range trading webinar, the stock market likes to range between 70 and 80% of the time, which only leaves 20 to 30% for it to be trend trading. So if we're able to understand how to trade a range, it really benefits us because that would be for trading for about 70% of the time. Breakout trading strategies typically involve moderate risk to reward ratios, aiming to capture significant price movements after the breakout occurs. So this would be a breakout strategy, not a fake out, not where we take the breakout and it completely reverses on us, but a full-blown breakout strategy where, say, price was accumulating near the key level for a while until it finally popped and broke through. We would take the pop, we would put our stop at the lows, and we would trend trade the break, because once we break that key level, it's usually because we were in a range and it's breaking out into a trend. So ES trading at $50 a point, number of points, risk value per point. So here's just some examples, guys. For MES is $5 a point, so if we are risking $40 a point, $200, but we're doing 4 points on ES for $200. So you do have to know what futures instrument or what trading or even a options contract that you're trading. Because when we are trading options contracts, let's say we buy one for 1.00, which is $100 for that contract, we could have maybe, let's say the delta is 0.25, we could have our stop loss at 0.25. So if the stock goes $1 against us, that will be our stop loss. Whereas we could have our take profit at 1.5, so it would be a $2 reward and a $1 risk, and that's how we would measure that, right? So with options, you would trade it based off of what the delta is doing. But again, guys, with options too, when it comes to 0 days, there are other futures and there are other, not other futures, but there are other Greeks that can affect the stock. There is theta, gamma, vega, all of these options, all of these Greeks that will affect that option. Whereas futures, if you get in ES at 4,500, it could chop around all day, but still be above 4,500, you're still green. Whereas options, if you get in SPY and it's at 440 and it chops around all day and ends the day at 441, your options contract, if let's say it was a 445 and it didn't get in the money and it was a 0 day, it's going to expire worthless, even though the option did move up since you bought it. But if you got a week out in expiration, then it might be a little bit better. But it always depends, with options, you really have to take into consideration what's the theta, what's the delta, when did it expire, so on and so on. Whereas futures, it's a bit cleaner, it's a bit more simple, it's more clear, your risk to reward is more defined. Importance of capital preservation. So protecting capital is crucial for long-term trading success and account growth, guys, right? So just like we mentioned how we want to be in consistent 3-to-1s, 4-to-1 risks and rewards, that will keep us out of the poor trades and might even keep us out of range trading. And that's going to help because then we're not taking an extra amount of losing trades. We're staying patient for the higher probability and higher profitability trades. Applying appropriate risk to reward ratios based on account size helps manage risk and minimize the impact of losing trades. So by preserving capital, traders can withstand drawdowns and have the necessary resources to take advantage of future opportunities. So again, guys, if you're 3-to-1 risk to reward, you're up 2 trades and then you lose 4 trades, you're still green, your account is still doing well. So prioritizing capital preservation contributes to maintaining a sustainable trading career. Again, guys, risk reward is huge. It might not sound like much. You might think, oh, well, I just want to trend trade. I'm just going to scalp. And that's fine too. You could scalp, you could trade momentum. There's all different trading strategies and different trading techniques. Risk to reward is just something that is proven and is mathematically proven to be something that can help you be consistent and stay consistent. So prioritizing capital preservation contributes to maintaining a sustainable trading career. Patience is always crucial in trading. Waiting for the right trade opportunities with good risk management can make a massive difference in your trading. So again, it comes down to feeling the need to always taking a trade. We don't have to always be in a trade when we're trading. We could wake up, look at the market opens 9:30, say it's chopping around from 9:30 to 10 and price isn't where you want it, then you don't have to force a trade. You could stay patient and wait it out. Wait till price gets there. Set an alert. Set a price level alert. So scaling positions with account growth. As the trading account grows, traders may consider scaling positions to adjust risks or reward sizes. So let's say you were at a 10K account, you were doing well, you're doing consistent, now you're at a 25K account. Your 2% risk has now grown and you're able to maybe add an extra contract or two depending on what you were trading and how much you were risking. So as our account grows, we're able to grow. That way, again, it keeps our losses minimal as long as we're able to capitalize on our gains. So with a larger account, traders can potentially take on more positions or increase position sizes while maintaining favorable risks or rewards. Again, as we mentioned, a $100,000 account versus a $10,000 account, they're not going to have the same risk. You might be risking 5 points on a trade and they might be risking 5 points on a trade, but the 10K account might be trading micros and the $100,000 account might be trading minis. So it might be a 5-point stop on both, but the value is not the same. So scaling positions should be done thoughtfully, considering risk management, available capital, and individual trading style. Again, guys, people who scalp might be more keen on being in and out, so their risk to reward, they might not be too focused on that. They might be, I'm just going to take this next candle, and if it fails and hits this previous candle, I'm stopping out. Again, that might be a 1-to-1, might be a 2-to-1 if the following candle does pump. Those types of traders, scalpers, momentum traders, they don't focus on risk to reward too much, whereas we can create trade plans. We can know where our areas of interest are. We want to know ahead of time what price we want to enter at and where our stop loss is. So that's what's great about letting the market form, is it creates higher lows or lower highs, and those lower highs and higher lows give us potential stop losses or areas of interest where stock might reverse. So adapting position size with account growth allows traders to optimize risk management and capitalize on a larger profit potential. So if we have a 5-to-1 risk to reward and we're on a 10K account, we're able to grow that account really quick. And if we stay on a 5-to-1 risk to reward, we could grow almost any account very quick as long as we stay disciplined and keep taking these 4-to-1s, 5-to-1 risk to rewards, because those will help us grow consistently. Why is consistency in risk to reward ratio important? So consistent risk to reward ratios contribute to overall trading consistency and discipline. It helps to eliminate the emotional decision making by following predefined risk management rules, just like using supply and demand and key levels gives us areas where we're going to look for a short or a long. Risk reward gives us areas where we're going to stop and take profit. So consistency in risk to reward ratios ensures a balanced approach to trading, minimizing the impact of individual trades on overall market portfolio performance, and over time, maintaining a consistent risk to reward ratio enhances the trader's edge and the potential for long-term profitability. Again, guys, it sort of does sound repetitive, but we have to remember, risk to reward, having a consistently high risk to reward will help us stay consistent in our trading day to day. And consistency is key. Whether you're consistent with your levels, consistent with your risk to reward, consistent with your price action, consistency is always key, and you have to work with what is working for you. Alright, so here's a little bit of math, guys. So the math behind risk to reward. The formula to calculate the break-even win rate, right? So the break-even win rate would be 1 divided by 1 plus the risk to reward. So for a 1-to-1 risk to reward, it would be 1 divided by 1 plus 1. So that would be 1 divided by 2 is 0.5 or 50%, and that's the break even. A 2 to 1 risk to reward is 1 divided by 1 plus 2, so 1 divided by 3 is a 33%. So a 2 to 1, you would need a 33% to break even. That's why 40% is profitable. You could be 33% for break even, and so on and so on. I'll leave that there for just a second, guys, if you do want to screenshot that, just a little bit of notes. I'm probably going to be wrapping this up. I don't think there are too many slides left. If anybody does have any questions, please feel free to pop them in the comments below. Don't forget, hit that like button. This was a great webinar. Risk to reward is something that is crucial in helping us as traders have consistently successful trades and have consistent weeks, consistent returns, and just consistency in general. And that's what we need as traders. Consistency is key. Yep, so that's about it. I do appreciate you all for tuning in tonight. And again, if you guys got any questions, this is stuff that we go over with our Bullishbrs community quite often. I'm sure most of you in here are members, and I appreciate you all for being part of the team. It's a great community. Let's see, rookie question. Alright, we got a question. When you trade ES, do you enter one action and then set your stop loss profit via another action? That is what I do, but when the market is going fast, can't do the second action. Yeah, Jim, that's a great question. So what you could do, let's see, I think I kept TradingView up because I was going to prepare for questions. And good, this is my trade station. So Jim, what trading platform do you use? Because definitely different trading platforms give us different abilities. So on something like TradingView, we're able to do the order panel, and here, let's switch to that. TradeOvate. So Jim, what's great with TradeOvate is with TradeOvate you could connect it to TradingView. And when you connect it to TradingView, you're able to place your orders on TradingView. So what we could do is we could have a buy limit, and it'll be the price. It'll be how many we want, not 20. Let's just say 2 for now. And then it could give you an automatic stop loss and it goes by ticks. So when we read 4 ticks is 1 point in ES. So if I want a 5-point stop, I'm going to have 20 ticks. And it's going to tell me my risk, and it's going to tell me the percent, the units, and then you just hit buy, and it will automatically fill you at the buy limit, and it will automatically set your stop loss for you. So if you already have your take profit too, let's say it's a 4 to 1, so you're looking at a 80, so now that's a good risk to reward. Now we're able to place order, it would buy it, and it would automatically implement our stop and implement our take profit. And that's how you do that. And let's say you were selling, you would do the opposite. You would sell, you would still have the same type of ticks for a stop loss. So you do it in one action and then adjust. Yeah, so you could do it in one action and adjust accordingly. What I like to do though, Jim, is what I'll do, ignore this this order right here, was just messing around, is let's say we were forming right up here. Let's do the replay system. Let's go right here, right? And let's play it out. Let's see how it's going. Get it up to 3. Let's go back a little bit. Alright, so let's say these candles were forming. This is the 5-minute chart, and this was your entry candle. So you could then say, let's use the short position, and that would be our entry. Our entry would be once this candle breaks below the open of this candle, because this would be a liquidity grab trade. And we would put our stop loss right here and our take profit down at a key level. Then we have our entry, we have our stop, and now let's say you did enter, but you don't want to go out of your way. You don't want to place a stop loss, place a target. You're able to enter as long as you have a mental note of where your stop is and you're going to respect it. What's great again with TradingView though too is this little plus over here is you're able to, add horizontal line. Usually it gives you the option to buy or sell there. I don't know why it's not. But it usually will say, yeah, that's not right. So you see how we have the DOM, the depth of market, but it'll usually give you the option. You could also right click on the tool and you could do objective tree. Nope, not objective tree. So sorry, I was on Thinkorswim for a little bit. Gotta get the, here we go. No, where is it? I'm gonna have to get back to you on this because there's a way to use the risk to reward tool on TradingView and to automatically place orders. So when you set this up, let's say that the let's go to 1, set it to speed of 1, set it right here. Let this go for just a second. Right, so now we have our entry was right here, we have our target, we have our stop loss. You're able to implement this trade, know where you're stopping, know where your target is. When you hover over this, it tells you it's a 4.6, so that's a 4-to-1 risk to reward, and it tells you here your stop is 3.25 and your target is 15 points, so that's a great risk to reward. Is there something? No, Tom, unfortunately, there's nothing like this on Thinkorswim. There's one thing that I use, but it's the fib extension, and what I do is I changed it from like the 0, 23, 61. I changed those to just 0, 12.5, 25, 50, 75, 100, and then I changed the negatives to negative 0.12, negative 12.5, negative 25, and negative 50. That way the negative 50 and positive 50 equal the 1-to-1, and when the negative 50 and positive 100 is a 2-to-1, and then it could also line up with the negative 12.5 and a 100%, and that would be like a 1-to-8. So it all depends. You could set that up, but it's definitely not as clean as TradingView. TradingView's got some great tools. It's a great charting platform. It's not a broker. TradingView is not a broker. I got a question about that on YouTube earlier, actually. TradingView is not a broker. TradingView is a charting tool. So TradingView is something that we could connect brokers to, whether it's TradeStation, Trade08, a whole bunch of different ones, right? So let's see. Let's log out of this real quick, right? And just an example, Interactive Broker is another one. TradeStation, Iron Beam. You know, they have their own paper trading system as well, but it's a great charting tool because the charts are very clean and there are price tools just like the short tool and the long tool. All right, guys. Does anybody else have any follow-up questions? I want a live replay so I can turn back time and bank. Yeah, Cliff, me too. That would be great. Do you keep the same risk to reward and the same trade strategy every time? If not, are there factors that may adjust the risk to reward selection? Yeah, so Victoria, that's a good question. That usually comes in when we're having like range trades, right? So if by any chance I was trying to trade this range right here, and this range, I would consider this range from like here to here, right? So if I'm trading this range, I'm going to be having a much smaller, let's do a long position, right? And say I wanted longs with the stop loss there and a target at a key level or a previous high. You see how now we're risking 1.25 to make 3.25. This is still a 2.6 to 1 risk to reward, so it's still a good risk to reward, but the point difference is much smaller. Before we were risking 3 points to make 15 points, whereas now we're risking 1 to make 3. But when we're in a smaller range, you're able to go heavier in contracts because we're smaller in range. So a 3-to-1 risk to reward on 3 points to 1 point is the same as a 3-to-1 on a 9 points to 3 points, because all that matters is that we have the right sizing. So if this range is 50% the size of another range, we're going to double the contracts. Got you, Victoria. Absolutely. That was a great question. I appreciate you asking that. That was something I wanted to go over, but I guess I missed it in the slides, but that was definitely a good one. I appreciate you. All right, does anybody else have any follow-up questions? I'm trying to keep these webinars to about 45 minutes to an hour. not too long, not too short. Keep everybody interested, keep everybody learning. And again, any other questions, please follow up. Definitely let me know in the comments. Definitely do appreciate it if you guys drop a like on the video. I put a lot of time and effort into these. Next week's webinar, guys, I usually don't announce the topic until the following week, but next week is going to be a great one. It's going to be on trading psychology and routine. It's going to be what routine does for us in trading psychology and how that affects how we trade. Awesome, Cliff. Awesome. Glad you enjoyed. Victoria, Cliff, Tom, Jim, everybody in here. Anthony, if you're still here. Everybody, I appreciate you all for tuning in. Good, Victoria. I'm glad it helped. Risk reward. It might be something that a lot of traders just sort of brush off, but risk to reward is sort of like journaling, right? It's something that a lot of retail traders don't do, but by doing what they won't do, we could help ourselves succeed because we go out of the way to make sure our trading strategy gets better, and we show up every day and we do better every day. Thank you, Frank. I appreciate that. How do you use the trade sell tool? Which sell tool? I know there's just the long tool and the short tool. The long position, which would be, right, so this would be if you want to go long, so it tells you your stop loss down here, your take profit up here. And then there's a short position, which would be just the opposite, where you would go short and your take profit is down here. Alright, does anybody else have any follow-up questions, Roberto? I didn't really understand what you meant by that question. If you want to run it by me one more time. If anybody else does have any other questions, definitely drop it below. Going to be wrapping this up. Don't forget, like and subscribe. We do this every week. And again, next week's webinar is going to be on trading psychology and routine. It's good to keep a routine because as humans, routine keeps us healthy and it keeps us in line. So if we don't have a routine and we're sort of just jumping into trades, there's no consistency there, and that also goes hand in hand. For that liquidity grab trade you showed there, is there something you would actually do, like enter solely because of the liquidity grab? Where's more signs are missing? No, so yeah, that liquidity trade, that liquidity grab trade is exactly that. A liquidity grab is a trade setup in itself. So let's see. So like again, the liquidity grab, a liquidity grab is when we break some previous swing highs. Again, this is a liquidity grab to go lower. So if we break the highs, fail it, have a big wick, right? And volume also is sort of picking up. Have a big wick. A lot of traders are trapped on the wrong side, and you also got to think there were retail traders that had their stop losses right up here at the previous high. So now those people just stopped out, and other people are taking the market long thinking we're pumping higher, but if they let the candle close, they would know that that is not the move and that was a fake out. Whereas our entry would be on the following candle, break of this candle, because this is the candle that created the liquidity grab, so we would wait for the candle to close, because if this candle didn't close like this, then most likely this could have been a trend. But because it closed like that, we could have taken it short once we broke it with our stop loss at the highs, and we would target a key level, or we would target previous lows. So that's exactly how that trade would be taken, just like that. Let's see. Gotcha, for sure. I think Roberta means, how do you link it to Trade08? Oh, it's a tool that tracks the number of contracts. Usually keep it. Oh, I got you. Are you talking about? So there's two tools that I use to enter and exit trades. There's the DOM. That's the DOM. That stands for depth of market. That's this tool right here. And then there's also. Oh, it's not going to show me now. It's not showing me now because I disconnected, but if you rewind in the video a little bit, I'm not going to connect to it now because then it brings up passwords and stuff. But if you rewind a little bit, we did go through this. This is the order panel. So when you enter, you could enter an order on here and already have a predetermined stop loss. And when you enter, the stop loss will implement as well. A lot of times as well, once I have my Trade08 connected, I'll usually right click and it'll give you an option to place a buy limit, a sell limit, a buy stop, a sell stop. And I'll usually click that. That way, when I'm clicking it, I'm knowing exactly what price I'm entering or exiting at. But that's how I would use this one. And then the depth of market is the same thing. I would click buy limit right over here if I wanted to buy something, or I would hit the sell over here if I wanted to sell something. All right. Think that wraps it up. Roberta, I hope that answered your question. I'm not too sure exactly what you're referring to. It's something on TradingView? Oh, it was the DOM. Okay, sure, absolutely. My pleasure. Absolutely. Yeah, I know we got to work on I'm going to work on a tutorial video going over how to use the DOM and also how to use the order panel as well for you guys, because I know those are two things that a lot of people have been asking about, and once you learn them, they are simple and they do help you with your trades to execute exactly where you are trying to enter and exit. So it's better than doing a market order, where a market order might fill you. Say we're trying to enter right here, instead of getting filled at 45.42, we might fill at 45.43, and that's going to sway our risk to reward. Alright, I do hope this helped, guys. I hope you guys have a great weekend. I will catch you all on Monday. There's no holidays coming up this week, so we have full 5 days of trading. I appreciate you all for tuning in. Don't forget to hit that like button one more time. Not like it matters, you can only hit it once. But I appreciate you all, and I will catch you guys all on Saturday. And if you're a member, I'll see you guys all on Monday. Alright, take care and happy trading.